March 6, 1933. Inside the Treasury Department in Washington, D.C., a cramped, dimly lit office sat buried beneath piles of telegrams, bank ledgers, and emergency memos. 5 of the most powerful financial officials in the United States stood around a table. No one spoke. No one wanted to say aloud what they all knew. Finally, Treasury Undersecretary Dean Acheson broke the silence. "Gentlemen, the banking system of the United States has collapsed." No one contradicted him. No one could. Across America, every bank door was locked. Depositors pounded on doors that would not open. Governors pleaded for help. Federal Reserve officials whispered that their vaults were nearly empty. And President Franklin D. Roosevelt, just 36 hours after taking office, had declared a nationwide bank holiday, shutting down the entire financial system with one stroke of a pen. This is the story of how America's bankers realized the game was over. The room smelled of stale coffee and cigarette smoke. Emergency telegrams covered every surface, stacked on filing cabinets, spread across chairs, pinned to walls with thumbtacks. The clock on the wall read 11:47 p.m. Dean Acheson stood at the head of the table, his collar unbuttoned, his tie loosened, his face gray with exhaustion. Around him sat representatives from the Federal Reserve Board, the comptroller of the currency, emergency liaisons from state banking departments across the nation, and 2 assistants whose only job was answering telephones that never stopped ringing. The telephone had not stopped ringing for 6 hours. Michigan, collapsed. Illinois, cascading failures. New York, holding by a thread. California, governors begging for federal intervention. Pennsylvania, riots outside closed banks. One Fed official pushed a single-page memo across the table. The paper was crisp, official, stamped with red ink. Acheson picked it up and read it without expression. Total bank suspensions in the last 72 hours, 4,004. Estimated deposits frozen, $3.6 billion. Gold reserves, 38.2% of currency in circulation. Legal minimum required, 40%. Status: below statutory threshold. He set the paper down carefully, as if it might shatter. His hands didn't shake. They had stopped shaking hours ago, when the magnitude of the crisis became clear. "The question is no longer whether we can stop this," Acheson said quietly. "The question is what we tell the president tomorrow morning." Another telegram arrived. An assistant read it aloud. "Baltimore, all banks closed by order of the governor. Philadelphia, withdrawals limited to 5% of deposits. Boston, Federal Reserve Branch reports gold reserves at critical levels." Outside, Washington was dark. Street lamps cast long shadows across empty sidewalks. Inside this room, the men responsible for America's financial system confronted a truth they had been avoiding for 3 years. The entire banking structure of the United States had become insolvent, and there was no mechanism left to save it. Not one that preserved the system they had known. Not one that protected the gold standard. Not one that kept the federal government from seizing control of money itself. Acheson looked around the table. He saw exhaustion. He saw fear. He saw men who had spent their careers believing that markets, left alone, would always self-correct. They had been wrong. To understand how the collapse happened, you must go back. Back to 1927, when America's banks were the envy of the world. When optimism was policy and credit flowed like water, the numbers told a story of triumph. Between 1922 and 1929, total bank deposits surged from $37 billion to $55 billion. Stock prices tripled. Industrial production soared by 50%. Unemployment fell below 4%. Ford Motor Company alone was producing 1 automobile every 24 seconds. Bankers called it prosperity. What it actually was? Leverage. The Federal Reserve kept interest rates low, deliberately, strategically. Easy money fueled expansion. Banks competed for deposits by offering higher returns. To pay those returns, They poured money into speculative investments, stock trusts, real estate syndicates, margin loans to investors buying stocks with borrowed money. By 1929, American banks held $58 billion in deposits, but only $4.3 billion in gold reserves backed the entire system. The ratio was dangerous. The bankers knew it. They assumed confidence would hold the structure together. In private meetings, Fed officials expressed concern. In public statements, they said nothing. The party was too profitable to stop. Consider this. In 1928, the average American bank held $7 in deposits for every $1 in reserves. The largest banks, the ones everyone trusted, were levered even higher. National City Bank held deposits of $2.4 billion against reserves of $180 million, a 13-to-1 ratio. It worked as long as everyone believed it would work. Confidence did not hold. On October 24, 1929, the stock market began to break. Margin calls cascaded through the system like dominoes. Investment trusts, levered 10-to-1, evaporated overnight. Banks that had loaned billions into the market faced sudden, catastrophic losses. But here's what most people miss. The real collapse didn't start in October 1929. The market crash was a shock. It destroyed wealth. It panicked investors. But the banking system survived. Deposits actually increased in late 1929 as people pulled money out of stocks and put it into banks. The real collapse started 14 months later, in December 1930, when a single bank in New York failed and triggered the first true banking panic of the Depression. The Bank of United States collapsed on December 11, 1930. Despite its name, it was not a government institution. It was a private commercial bank serving mostly immigrant communities in New York. It held $200 million in deposits. It had 400,000 depositors. Jewish immigrants, working-class families, small business owners who had saved their entire lives. When the doors closed, crowds surrounded the building. Police formed barricades. Families wept on the sidewalk, holding passbooks that had become worthless overnight. The failure sent a signal. No bank was safe. Within 60 days, 608 banks across America suspended operations. The psychology shifted. Depositors began withdrawing cash, not from failing banks, but from solvent ones. They didn't trust balance sheets. They didn't trust assurances. They trusted gold coins and paper bills hidden in mattresses. The Federal Reserve could have stopped it. They had the tools. Lend aggressively, flood the system with liquidity, guarantee deposits, act as the lender of last resort. They chose not to. Fed officials believed the panic would cleanse the system of weaker banks. They called it necessary discipline. They quoted economic theory. They cited the need for banks to learn prudence. What they called discipline was mass contagion. By the end of 1931, 2,294 banks had failed. $1.7 billion in deposits gone. Agricultural regions were devastated. In Iowa, farmers organized penny auctions, where they bought foreclosed farms for $1 and returned them to their original owners. In Nebraska, farmers dynamited their own banks in rage. And still, the officials in Washington insisted the system is fundamentally sound. This is a temporary adjustment. Confidence will return. They were lying. Or they had no idea how bad it really was. The truth was buried in reports that few people read. In Kansas, 57% of banks were insolvent but still operating. In Mississippi, 61%. In Arkansas, bank examiners stopped publishing accurate data because they feared the truth would cause immediate panic. The entire system was rotting from within. In 1932, the contagion accelerated. Bank failures triggered more bank failures. The mechanism was simple and devastating. When a bank closed, it froze deposits. Businesses that banked there couldn't pay suppliers. Those suppliers couldn't pay their workers. Workers couldn't make mortgage payments. Landlords couldn't pay property taxes. Cities couldn't fund services. More banks failed. Every closure made the next one more likely. President Herbert Hoover understood the danger. In January 1932, he created the Reconstruction Finance Corporation, a federal agency empowered to loan money to failing banks. Congress appropriated $500 million. Hoover called it a rescue mechanism. Newspapers called it a bailout. It didn't work. Bankers refused to apply for RFC loans because accepting one signaled weakness. Depositors would see the news, local bank receives federal loan, and panic. They would assume the bank was failing. They would withdraw their money. The bank would collapse. The very existence of the rescue mechanism made banks afraid to use it. Meanwhile, gold was disappearing. Wealthy Americans and foreign investors began converting dollars into gold and shipping it overseas. They saw what was coming. They read the bank failure statistics. They heard the rumors. They moved their wealth. Between January and July 1932, $1.1 billion in gold left the United States. To put that in perspective, total U.S. gold reserves were $4.2 billion. In 6 months, the country lost more than a quarter of its gold supply. The Federal Reserve watched its reserves drain. Under the gold standard, the Fed was legally required to back at least 40% of the currency supply with gold. By summer 1932, they were approaching that threshold. If gold reserves dropped below the legal minimum, the Fed would be forced to either suspend the gold standard and break the international monetary system, or contract the money supply, raising interest rates and triggering deflation and even more bank failures. Both options were catastrophic. Treasury Secretary Ogden Mills sent a confidential memo to Hoover in August 1932. "We may not have 6 months. Gold outflows are accelerating. Major banks in New York have privately indicated they cannot survive another large-scale withdrawal. We are approaching systemic collapse." He was right. They had 7 months. January 1933 arrived with a sense of dread. Roosevelt had won the election in November, but he wouldn't take office until March 4th. 4 months of a lame duck president, 4 months of paralysis, 4 months of waiting. The banks didn't have 4 months. In January, 87 banks failed. In February, the number jumped to 274. State governors began preparing emergency measures. Hoover sent urgent messages to Roosevelt, begging him to issue a joint statement of confidence. Roosevelt refused. He would not inherit Hoover's crisis. He would take power with clean hands and full authority. On February 14th, Valentine's Day, the dominoes began falling in earnest. Governor William Comstock of Michigan faced an impossible choice. Detroit's 2 largest banks, Guardian Detroit Union Group and First National Bank, were hours from insolvency. Combined, they held $1.5 billion in deposits. If they failed, the entire state banking system would collapse within days. Comstock made a desperate call to Henry Ford. Ford controlled massive deposits in Detroit banks, over $25 million. If Ford agreed to leave his money in place and make a public statement of confidence, the banks might survive. Ford refused. He wanted his deposits, all of them, immediately, in gold. At 1:32 a.m. on February 14th, Governor Comstock signed an executive order closing every bank in Michigan for 8 days, a cooling-off period, he called it. The announcement went out at dawn. Michigan, America's industrial heartland, home to the automotive industry, a state with 550 banks serving 4.5 million people, had just shut down its entire banking system. Panic spread like fire. Maryland declared a bank holiday the next day. Ohio followed. Indiana, Arkansas, Illinois. Within a week, banks in 21 states had either closed entirely or imposed severe withdrawal restrictions. In New York, depositors formed lines 3 blocks long outside major banks. J.P. Morgan himself arrived at his bank at 6 a.m. to personally reassure customers. He stood in the lobby, shaking hands, promising that every dollar was safe. It didn't help. Withdrawals accelerated. By noon, Morgan's bank had processed $20 million in withdrawals. The Federal Reserve Bank of New York reported that gold outflows had reached $15 million per day. At that rate, reserves would breach the legal minimum within 2 weeks. On March 2nd, 2 days before Roosevelt's inauguration, the New York Federal Reserve sent an encrypted telegram to the Board of Governors in Washington. Gold position critical. Legal reserves may be exhausted by March 6th. Recommend immediate suspension of gold convertibility. Alternative is complete collapse of banking system. Await instructions. The governors debated through the night. Suspend gold convertibility and abandon the international monetary system that had existed since 1879, or let the banks collapse entirely and hope that somehow the system could rebuild itself. Before they could decide, Herbert Hoover made one last, desperate move. March 3rd, 1933. 11 p.m. Herbert Hoover sat alone in the Oval Office, drafting telegrams. In 12 hours, Franklin Roosevelt would be inaugurated. Hoover's presidency was over, but the banking system was collapsing in real time, and Hoover wanted Roosevelt to share responsibility. He sent an urgent message to Roosevelt's hotel suite at the Mayflower. Request immediate joint statement declaring bank holiday and suspension of gold payments. Situation cannot wait until after inauguration. System will be insolvent by morning. I am prepared to sign any proclamation you approve. Roosevelt's response came back within an hour, delivered by courier. No. Roosevelt refused to co-sign anything. He would take office with full authority and no shared blame. Whatever happened next would be his decision alone. Hoover sent 3 more telegrams that night, each more frantic than the last. Roosevelt ignored all of them. At 2 a.m., Hoover received a phone call from the governor of New York. Every major bank in the state would close at dawn unless the federal government intervened immediately. Hoover had no power to intervene. Not anymore. At 4 a.m., Hoover finally went to bed. The banking system would collapse on someone else's watch. At dawn on March 4th, Franklin Roosevelt took the oath of office on the east portico of the Capitol. Chief Justice Charles Evans Hughes administered the oath. Roosevelt placed his hand on a 300-year-old family Bible. The crowd, over 100,000 people, stood silent. Roosevelt's inaugural address lasted 15 minutes. The most famous line, "The only thing we have to fear is fear itself." By the time he finished speaking, 5 more states had declared bank holidays. Roosevelt had been president for 6 hours when his Treasury Secretary, William Woodin, brought him the numbers. 5,204 banks suspended or closed. $3.4 billion in frozen deposits. Gold reserves 8% below legal minimum. Major New York banks estimated 12 hours from insolvency. Chicago banks expected to fail by Monday. Federal Reserve branches in 7 cities reporting critical reserve levels. Roosevelt looked at the report. Then he looked at his advisors. Men he had known for years. Men he trusted. How fast can we close every bank in the country? The meeting lasted 14 minutes. Roosevelt's team presented 3 options. Option 1, let the crisis play out. Allow weak banks to fail. Markets would eventually stabilize. This was the classical economic approach, what the Fed had been doing for 3 years. Option 2, close weak banks. Shore up strong ones. Selective intervention. Use the RFC to prop up major institutions while letting smaller ones collapse. Option 3, close everything. Shut down the entire banking system. Give the government time to examine every bank. Separate the solvent from the insolvent, and reopen only those that could survive. Roosevelt chose option 3 immediately. His reasoning was simple. Partial measures had failed for 3 years. The public had lost confidence in the entire system. The only way to restore confidence was to reset completely. Close everything. Examine everything. Reopen only what was sound. It was radical. It was unprecedented. It was, technically, illegal under existing law. Roosevelt didn't care. At 1 a.m. on March 6th, he signed Proclamation 2039, invoking the Trading with the Enemy Act, a World War I-era law that gave the president emergency powers over financial transactions during wartime. The United States was not at war. Roosevelt used the law anyway. The proclamation declared a nationwide bank holiday. Every bank in America, commercial banks, savings banks, trust companies, credit unions, would close for a minimum of 4 days. No deposits, no withdrawals, no transactions of any kind. At 2 a.m., Treasury officials began calling governors. The message was identical, read from a script. The President has ordered all banks closed under the authority of the Trading with the Enemy Act, effective immediately, no exceptions. Inform local law enforcement. Advise bank executives. Maintain order. By dawn, police officers stood outside every bank in America. Silence. That's what people remembered most. The eerie, unnatural silence of a nation without money. In New York, the lobbies of J.P. Morgan and Chase National Bank sat empty. Marble floors reflected no footsteps. Teller windows stared into darkness. Security guards stood at locked doors, turning away customers who arrived with briefcases and desperate expressions. In Chicago, shopkeepers put up signs, no checks, no credit, cash only. But no one had cash. People had bank accounts, passbooks, checkbooks, all suddenly worthless. Grocery stores closed by noon. In Los Angeles, film studios shut down. Without access to payroll accounts, they couldn't pay workers. Production stopped mid-scene. Actors went home. Studios went dark. In Detroit, automotive factories ran on skeleton crews. Workers showed up but couldn't be paid. Some stayed anyway, out of loyalty or hope, or fear of losing their jobs permanently. Across America, 18,000 banks were locked, $41 billion in deposits, frozen. Families that had money in the bank couldn't buy food. Businesses couldn't make payroll. Farmers couldn't sell crops because buyers had no money to pay. Cities couldn't collect taxes. Schools couldn't pay teachers. The entire economy had stopped. And inside the Treasury Department, Dean Acheson and his team confronted the magnitude of what had just happened. They had reports from every state. Bank examiners were going through records, calculating insolvency ratios, determining which institutions could be saved and which were beyond rescue. The numbers were worse than anyone had admitted publicly. Of the 18,000 banks that had closed, Treasury examiners estimated that fewer than 12,000 were genuinely solvent. At least 6,000 were insolvent. They owed more than they owned. Their depositors would never see their money again. Acheson looked at the data, charts showing deposit levels, maps showing bank failures, lists of institutions too far gone to save. Then he looked at the other men in the room, Fed officials, Treasury staff, bank examiners pulled from states across the country. The system as we know it cannot be reopened. No one disagreed. The old banking system, the one built on gold reserves, private capital, minimal regulation, and the assumption that markets would self-correct, had died. What came next would be something entirely different. Congress met in emergency session on March 9th, 3 days after the banks closed. Roosevelt sent them a bill, the Emergency Banking Act. It had been drafted in less than 72 hours by a team of Treasury officials and lawyers working without sleep. Most congressmen had never seen it before the vote. Some hadn't even read it. The bill passed the House of Representatives in 38 minutes. Voice vote. No debate. The Senate approved it 4 hours later, 73-7. Roosevelt signed it into law that night at 8:36 p.m. The Emergency Banking Act gave the federal government unprecedented power over the financial system. The Treasury could seize control of any bank deemed insolvent. Federal examiners would audit every bank in America. Only institutions deemed sound could reopen. The government could inject capital directly into banks by purchasing preferred stock. The Reconstruction Finance Corporation could buy bank stock, effectively nationalizing failing institutions. The president could regulate and restrict gold transactions. In effect, the federal government had nationalized the banking system. Private banks would still exist, but they would exist under federal supervision, subject to federal rules, backed by federal guarantees. The age of laissez-faire banking was over, but the real revolution came 2 months later. On April 5th, Roosevelt signed Executive Order 6102, the title forbidding the hoarding of gold coin, gold bullion, and gold certificates. It made it illegal for Americans to own gold. Citizens were required to turn in all gold coins, bullion, and certificates to the Federal Reserve in exchange for paper dollars at the rate of $20.67 per ounce. The deadline, May 1st, 1933. The penalty for non-compliance, $10,000 fine and 10 years in prison. By May, $300 million in gold had been confiscated from American citizens. The Treasury melted it down and stored it in vaults. The gold standard, the foundation of American money since 1879, was effectively dead. On January 30th, 1934, Roosevelt officially devalued the dollar, reducing its gold content from $20.67 per ounce to $35 per ounce, a 41% devaluation. Overnight, the government's gold hoard increased in value by billions of dollars. The Treasury used that windfall to recapitalize banks and fund New Deal programs. The message was clear. The government, not gold, now backed the American dollar. March 12, 1933. 10 years p.m. Eastern Time. Roosevelt sat in the diplomatic reception room of the White House, preparing for his first fireside chat. Radio networks had promoted it for days. 60 million Americans gathered around radios in living rooms, kitchens, barbershops, and corner stores. He spoke for 13 minutes. His voice was calm, reassuring, conversational. He explained the banking crisis in simple terms. He told people what had happened, why the banks had closed, and what the government was doing to fix the problem. I can assure you that it is safer to keep your money in a reopened bank than under the mattress. He explained the examination process. He promised that only sound banks would reopen. He asked for patience. He asked for trust. The next morning, March 13th, banks began reopening in stages. Treasury officials had divided institutions into 3 categories. Class A, sound banks with adequate reserves, reopen immediately. Class B, weak but salvageable banks, reopen with restrictions on withdrawals. Class C, insolvent banks, remain closed, liquidate assets, depositors will receive partial payment. On March 13th, 5,000 banks reopened in the 12 Federal Reserve cities. Customers lined up outside, not to withdraw money, but to deposit it. In New York, Chase National Bank reported deposits of $10 million in the first 2 hours. In Chicago, Continental Illinois took in $8 million. Across the country, money flowed back into the system. By March 15th, 3/4 of the banks had reopened. Within 2 weeks, $1.2 billion had flowed back into the banking system, money that had been hidden in mattresses, buried in backyards, stashed in coffee cans. The panic was over. But what had actually happened? Roosevelt hadn't fixed the banks. He hadn't injected massive capital. He hadn't guaranteed every deposit. He had simply told people the banks were fixed. And it worked. Because what collapsed in March 1933 wasn't just a financial system. It was a belief system. People had lost faith in banks, in gold, in the idea that their money was safe. Roosevelt replaced that broken belief with a new one. The government would protect your money. The government would examine the banks. The government would make sure the system was sound. It was a manufactured miracle. But miracles don't have to be real to work. They just have to be believed. By June 1933, 12,017 banks had reopened. 5,000 never would. Those 5,000 closed banks represented $1.3 billion in lost deposits. Millions of Americans lost their savings. Small businesses went bankrupt. Farmers lost their land. Families were ruined. But the system survived. The Federal Deposit Insurance Corporation was created in January 1934, guaranteeing deposits up to $2,500. For the first time in American history, your money in the bank was backed by the full faith and credit of the United States government. If your bank failed, the government would pay you back. The risk of a bank run disappeared overnight. Banking would never be the same. The era of private, lightly regulated finance was over. In its place, federal supervision, capital requirements, deposit insurance, and centralized monetary control. The Glass-Steagall Act separated commercial banking from investment banking. Banks could no longer speculate with depositor money. The Securities and Exchange Commission was created to regulate stock markets. The federal government now controlled every lever of the financial system. The bankers who had built fortunes in the 1920s watched their world evaporate. J.P. Morgan, Jr. testified before Congress, grilled about tax evasion and speculation. The House of Morgan, the most powerful private bank in America, survived but never recovered its dominance. Some adapted. Most didn't. By 1935, half of the major private banking houses had closed or merged. The new banking system was federal, bureaucratic, regulated, safe, and boring. The gold standard, the anchor of international finance for a century, was dead in America and dying everywhere else. Britain had abandoned it in 1931. France would follow in 1936. By 1940, no major economy was still on gold. The entire global monetary system was collapsing and being rebuilt in real time. And at the center of it all, March 6th, 1933, the day everything stopped. 6 weeks later, late April 1933, the same cramped office in the Treasury Department, Dean Acheson sat alone, reviewing reports in the dim light of a desk lamp. The crisis had passed. The banks had reopened. Confidence had returned. Deposits were flowing back into the system. Outside, Washington was quiet. Spring had arrived. Cherry blossoms bloomed along the tidal basin. The newspapers were calling it the Roosevelt miracle. But Acheson understood what most Americans did not. The system that collapsed on March 6th had not been reformed. It had been replaced. The government now controlled money in ways unimaginable 4 months earlier. Federal power had expanded into every corner of finance. The independence of private banking was gone forever. The gold standard, the sacred principle that money had to be backed by metal, had been abandoned. He picked up a memo from the Federal Reserve, dated March 5th, the day before the collapse. It estimated that 15% of banks were insolvent and recommended measured intervention. Acheson smiled bitterly. Measured intervention. By March 6th, the entire system was insolvent. Not 15%, not 30%. The whole structure, from the largest Wall Street banks to the smallest rural credit unions, had been built on leverage, speculation, and confidence. When confidence broke, everything broke. He placed the memo in a folder marked Confidential, Banking Crisis, 1933, and locked it in a drawer. Someday, historians would ask, how did America's banking system collapse so completely? How did the richest nation on earth shut down every bank in a single day? And the answer, Acheson knew, would be uncomfortable. It didn't collapse on March 6th, 1933. It had been collapsing for 3 years, since December 1930, when the Bank of United States failed, since October 1929, when the stock market crashed, since 1927, when banks started leveraging deposits into speculation. March 6th was simply the day everyone finally admitted it, the day the illusion ended, the day the old system died, the day the bankers stood in that small, smoke-filled room and understood the game was over. Not just for the insolvent banks, not just for the depositors who lost everything, but for the entire philosophy that had governed American finance since the founding of the Republic. The idea that money should be backed by gold. The idea that banks should operate freely without government interference. The idea that markets would self-correct and confidence would hold. All of it gone in a single day. Acheson turned off the desk lamp and walked out of the office. The hallway was empty. His footsteps echoed on marble floors. Somewhere in the building, lawyers were drafting new regulations. Economists were calculating reserve requirements. Bank examiners were preparing to supervise thousands of institutions. A new system was being born. Federal, centralized, controlled. And the bankers who had run the old system, they would adapt or disappear. The game was over. A new one was beginning.